Hey folks, this is Eric Chapelle, the South Jersey real estate guy. I work with Weichert Realtors in Cherry Hill, New Jersey. Today I'm actually in my office in Cherry Hill, and I wanted to make a quick video to talk to you about interest rates. Some of my clients recently have been hesitant in moving forward because they're afraid the interest rates are too high and that they're going to be paying too much money in their mortgage payment for their house. I get it. I understand where they're coming from, but many of you probably don't remember this, but it is 1981, interest rates were about 18%. Now that's been about 40 years ago. And I know that you think, well, that was ancient history. People were stupid back then. Home prices were a lot less. I get it. Home prices were less, rates were higher, people's mortgage payments were crazy. I get all of that. However, last year in December, you had rates as low as 6.19%. Those people that were at 18% in the 80s would have died to have a 6.19% finance rate for people with good credit. It's all relative. Now, home prices have gone up. So what you've noticed is interest rates were high, and now they've dropped down to 6%, 7%, but home prices have climbed up much higher. And that's kind of the way things go. As interest rates fluctuate, home prices can actually fluctuate. You say, well, I'm going to wait for that rate to come down. Well, that could happen. I get it. You might be waiting a while and it could happen. But understand this, if the rates go down, that means more people who, like you, who've been waiting for that rate to come down will jump into the market. And when there's more buyers than there are homes for sale, home prices tend to creep way up. We saw that right after COVID and during COVID, where home prices just went off the charts. Why? So many buyers, so little inventory. The rates were driving people into the market, and you paid a lot more money for your house than you should have. So with that being said, if that 6.5%, 7% interest rate right now for people with qualified credit, it's not that big of a deal. You actually can get good deals on homes right now. You're not going to have to overpay, and your mortgage payment isn't going to be that much different than if you were to wait, because you're going to end up paying more at a lower rate, whereas now you may pay less at a little bit higher rate. Okay? Just saying. But here's another thing. Once you've locked in your home, it's your home. If interest rates were to go down, there's this little thing called refinancing. You've heard of it. I'm not telling you anything different, but let me give you a personal illustration. And I hate to do this because most people think you're just tooting your own horn, trying to make people see how, wow, you're so awesome. You're a financial genius. I'm not. I was just lucky and it happened. My first house actually my second house I bought in New Jersey was in Gibbsboro, New Jersey, right near Voorhees. And I paid, I don't know, $160,000 for the house. And my interest rate at the time, even though I had good credit, was 7% interest. My mortgage payments were between, I want to say $1,400 or $1,600 a month, which I know that's not a lot. Some of you die to have that. You know, right now you're paying more in rent, so you'd die to have that payment. Well, remember, I was at 7%, but home prices were still pretty low. After we bought our house, we loved our house. We did a lot of repairs, a lot of fixing up. But about 2 years after we were in our home, something crazy happened. Interest rates dropped down to like, I don't know, high twos, 2.89 was the buy rate for the banks. And if you had good credit, you'd be somewhere like around, I don't know, annual percentage rate was like 3.29. So with that being said, we contacted our banker and he said, sure, we can refinance your home. And by refinancing your home, there was a cost. It was a couple $1,000s, like around $2,500. We can get you a rate at 3.25%. Now, here's what happened. Remember, we had already locked in our home. We already had it. Everything was done. We were enjoying our property. We were okay with our payment at around $1,500, $1,600 a month. But that was a 30-year mortgage. When we were able to secure a refi at 3.25%, our house payment went down to just over $1,300 a month. I want to say it was about $1,380 some a month. That's memory. I'm old. It's like cottage cheese up there sometimes. This stuff slips in and out, but that's what I think it was. And not only that, you said, well, that's not much of a savings. Well, it was substantial, almost $200. But the best part was we cut our term in half. We were at a 30-year mortgage. We switched to a 15-year mortgage at those rates and kept our payments lower. So here's what I'm trying to get at. If you were to buy a house today and you were paying 7%, but you loved your house, you've locked it in, if rates were to drop, you could do the same thing. You could refinance, probably lower your interest rate payment and actually lower your mortgage payment and cut your term if you had to, or keep your payment the same but cut your term in half. Either way, it's a win-win for you. But if you wait and interest rates were to drop, please know buyers are going to flood the market. Sellers are going to start selling their homes at higher numbers. Why? Because there's a lot of people out there who want their house, and you're going to end up paying a lot more money for a home that you could save money on today at a 7% rate. Just a thought. Please keep it in mind as you're churning these things over. If you're trying to decide, is it a good time to buy? Is it a bad time to buy? Think about these things. Do not let rates dictate your behavior. We date the rate, we marry the house. And never forget that. This has been Eric Chapelle, the South Jersey real estate guy, trying to give you a bit of advice today when it comes to interest rates and buying a home. Talk to you again soon.